importance of moving averages. Now, every time that I give a webinar, whenever I give a seminar, whenever I'm going to a group of traders, whenever I'm meeting people in the office, seems like the first thing they want to ask me is, what should I buy today, or what should I sell today, or where do I think the prices will be later today or tomorrow? The fact is, I don't have a crystal ball. I don't have a Ouija board, and neither does anybody else out there. Now, granted, there's all these gurus out there, all these people making, putting content out there. 50% of the time they're right, 50% of the time they're wrong. But believe me, when they're right, they promote it all over the place. I remember a year or so ago, all of a sudden you're seeing all over MSN, Financial News, Wall Street Journal, about some broker, some analyst I had never heard of, that predicted the market crash. He's a genius. He made $75 million. But when you look it up, you say one day he said this, the next day he said that, the next day he said this, all opposing. And you know what? He lost $75 million the day before. He made $75 million today, and he lost it next week. Fact is, nobody knows. Okay. Now, if you're here in class hoping that I'm going to tell you how to do this, I can't. But if you're here attending this webinar with the hopes that technical analysis and things like moving averages will improve your investing knowledge and help you become a better trader, that I have good news for you. That it will probably do. Now, moving averages help Forex traders and CFD traders make effective transactions by aiding them in evaluating the price history of a currency pair or related investment. More specifically, these averages make it easier for investors to interpret price fluctuations of an asset by smoothing out their random movement. Or in other words, moving averages takes the noise out of the markets. Because price, no matter how much we would like to say, price goes like that, price doesn't. It goes like this. And there's a lot of noise in this. A moving average smooths it out and lets us see what is happening in the markets easier. There's an old-fashioned saying about moving averages, and there's an old-fashioned method called red light, green light. And it says that you would only make a trade, a buy trade, when the price is above the moving average. You would only sell when the price is below the moving average. It's really pretty basic, and we really don't want to make trading decisions that simple, simple or that fundamental. But most of us don't realize that moving averages are the basis of most technical indicators. Now, technical analysts have harnessed a wide range of indicators over time, but the moving average stands out due to its simple, practical, and useful nature. By using it, traders can identify the price trends as well as the resistance and support of a security in question. Now, even though it's very simplistic, do you realize that a moving average is the basis of Bollinger Bands? A moving average is the basis of MACD. Moving averages are used in almost every indicator. Some way, some shape, somehow. Now, moving average, and there's many different types of moving averages. That's what we're really going to talk about tonight. But when we talk about the basic simple moving average, and it is the most simplistic calculation that we can use in price. Actually, let's go over to a live chart and see it in real life. Okay. Now, what we're looking at is my standard teaching chart. This is the Euro US dollar live chart. And the orange line going across. Now, you can spend time looking at all my dashes and my dots and my solid lines, Those are my levels of support and resistance that I always have on my charts. And they are my own personal key code as to whether dash, what colors are, how, because they just tell me how long they've been in effect, how effective they are, how strong they. Okay. But this is my own key method. And I therefore never take them off my charts. So for tonight's class, I dropped on here a moving average. This is the gold line moving through price. And what we're looking at right now is called a simple moving average. A moving average simply takes the close of whatever period you're looking at, whether you're looking at a 10 period, a 9 period, a 12 period, a 14 period, a 30 period moving average, takes that many candles back and adds the close together of all of them and then divides it by that number. So if we're looking at a 10 period moving average and we're looking at a 1 hour chart, we would go back 10 hours and take the close. We'd go back 9 hours, take the close, 8 hours, and we would take the close of each one of these candles and add them together and divide it by 10. And whatever that number was, we'd put a dot on our chart and we would connect those dots together and that would give us our moving average line. But as I said, that is really simplistic. And the fact is, this is a lagging indicator because when we're going backwards and we're using the close from 10 periods, in fact, we have to wait for the most current period to end before we can tally it in. It's always going to be lagging because we are always using the numbers that have already happened. And the fact is, all indicators, no matter how you want to crunch them, only can use the open, the high, the low, the close, and volume. And the rest are statistical or mathematical calculations applied to them. Now, again, a simple moving average is really simplistic. Okay. I don't use them for anything. There's nothing wrong with them, but because they do lag a great deal and they're very simplistic. But a moving average, thanks to these IT developers, we've got HTML charts. We've now got not a handful, hundreds of indicators we can automatically drop on our charts. But these developers, these IT gurus that have developed all this stuff, don't understand the world of trading. And they think, and their bosses and their bosses' bosses, who all fall into a technical world of software and developers and everything, who really aren't traders and don't really talk to the traders on the floor or in the office. They don't even talk to the analysts in the office. They want to give us choices. And the reason I'm saying this is because it's really kind of little bits of information, but it's really kind of important. So when we look at a simple moving average, okay, they give us way too many choices. Now, the easiest choice is your simple moving average always should be based on your chart. If you're looking at a 1 hour chart, it will give you a simple moving average based on 1 hour. But these developers allow you to pick any time frame you want. So you could use a 1 hour chart and drop a 30-minute moving average on it. Wow, that makes things really confusing. Now, the length of the moving average is very, very important. Okay, and we're going to go over time periods shortly. Now, when I started trading, and the way I was taught to trade, and the way most people learn about moving averages, is a simple moving average, and even an exponential moving average, is all based on the close. It was never even a question. I was just taught this way. When you calculate a moving average, you use the close. And in those days, we didn't have all this information. But these developers have decided to give us this source, and we could pick for the calculation. We could use the opening price for those 10 periods. We could use the high, the low, the close. We could use the high, the low divided by 2, the high, the low, and close divided by 3. We can use a smoothing line. It gets so complex that we have choices coming out our ears. the fact remains we should use the close. It doesn't make much of a difference because we're trading in pips 4 decimals over the right, and it's so minute that none of it matters. But what happens is, because we have all of these choices these days, some of these gurus out there come up with these weird things. Like if you use a simple moving average, but instead of using close, you use a HCL or OHCF, open, high, low, and close divided by 4, or use a high, low, close, close divided by 4, and then do this, do this, do this, and they tell you you're always gonna get a winning trade. Hogwash. So I stick to the basic fundamentals. Enough on that. But again, the problem with a simple moving average is it's got a big lag time. And traders, and especially online traders and short-term traders like us, we can't afford that lag time. We need something that is a very short lag time, if anything, but we much prefer something that's leading the market, telling us what's about to happen. Well, you kind of can't do that. And there's very few indicators that will predict the future. But we can minimize the lag time by using what's called an EMA. And an EMA is an exponential moving average, which was developed to give or reduce the lag time of a moving average. So what the gold line is right now is a 10-period moving average based on the close for the euro US dollar. Now I'm going to drop on here a 10-period moving average using an EMA, and that's the purple line. We see it's pretty much the same, but it diverges or is diverse by a little bit, and it's actually more responsive at the very end. There's a slight difference. A moving average puts more weight on the most current time frames. So instead of using the calculation like for simple moving average, we go back 10, close, add them together, and divide it by 10. An exponential moving average uses the formula to put more weight on the most recent close and therefore less weight on the oldest close. So in other words, if gold was trading at 1400, 1400, 1400, 1400, went to 1425, 1450, back to 1425, back to 1400, we had it all together, but the most current time frame, it went up to 1450. We added all that together and divided it by 10, we come out with 1403. But the fact is, gold took a huge jump in this last time frame, and that's really not reflected properly. So an EMA would give more weight in that calculation to that jump to 1425. Now, and not a big one, but it might move that moving average from 1401 or 1402 to 1408 because it gives us more information about the most current time frame. And we're more concerned what has happened very recently as opposed to necessarily 10 time frames, 12 time frames, 20 time frames back. So let's go back to my PowerPoint for a minute, and I'll show you how an EMA is calculated. You'll never have to calculate it. You just click on your charts and tell it to do an EMA, and it'll do all the calculations for you. So calculating an EMA is a bit more complicated as the indicator gives more weight to the most recent values in order to reduce the lag time. And it's a pretty simple calculation, time consuming, you'll never have to do it, but it adds a multiplier. And this multiplier is equal to 2 divided by the number of time periods plus 1. So since we've been talking about a 10-period time frame, we would take 2 divided by 10 periods and add 1 to it. So in other words, 2 divided by 10 plus 1 would give us 0.18 or 18.18%. That becomes the multiplier. Okay. For a 20-day moving average, it would become 9.52. Okay. That's the multiplier. So once this multiplier has been acquired, we then would take the multiplier times the closing price from the previous period plus the previous EMA. So in other words, we're dropping off the old 10 period, adding the 9 periods, and adding that multiplier to the most current period, giving more weight to the EMA. So an exponential weighted moving average puts more emphasis on the current price rather than simply averaging the prices together. So now that you know the differences in the two EMAs, okay, let's go, and we're on my chart, and we don't need to see this simple moving average in gold anymore, so I'm going to go hide that. And we have a 10 period EMA on our charts. Now, a lot of traders use a combination of two different time frames. So in this case, for class, we're going to use a 10 and a 20 period EMA. Let's put this on so you can see a little bit better. And let's make it this weird color violet here. Okay. So now what we have on our charts are two moving averages, both exponential moving averages, one at 10 period, one at 20 period. And again, we'll go on and talk about time frames and periods in a minute. Now, what we have on our charts is what's called a moving average crossover strategy. And there's many ways you use these two moving averages in your decision-making capacity. Now, let me explain one thing, or wording here first. We talk about short and long, or fast, actually fast and slow moving averages. Now, based on what I told you about a moving average, whether you're using an EMA or an SMA, the shorter the time period. So in other words, if you're looking back at gold over 5 time periods, it's going to still respond to the most current time period faster because you have only 5 periods and dividing it by 5. If you were to take that same thing and look at it over a 20 period and add the 20 closes and divide it by 20, that would be a slower moving average because it's reacting over a longer period of time. So it's going to be much slower in adjusting to the most current time period, whether you're using an EMA or an SMA. And it's only for wording and understanding. So the shorter the time frame, or when you're using a combination of moving averages, the shorter of the time frames is referred to as the faster moving average because it responds faster to the price changes. The longer period is referred to as a slower moving average. So in this case, we have a fast moving average and a slow moving average. When they cross each other, the markets are trying to tell you something. Some people use these as transaction signals. When the slower crosses the faster, you sell. When the faster crosses the slower, you buy. This is simply a moving average crossover strategy. Very simplistic, but it does give you some market information. There's another strategy that refers to this space here as no man's zone. When price is moving in between, like here, when price is making in between in no man's zone, you don't make a trade. When the price is above this moving average, you would buy. When price is below this moving average, you would sell. There's other strategies that use how far they fan apart from each other. And then there's things like MACD, moving average convergence divergence indicator, that tracks the difference between these levels and puts it on another indicator below on your charts. So there's many ways that we can use moving averages to understand what price is trying to tell us. Because all we're trying to do is interpret price. Now, a lot of people say moving averages can give you support and resistance levels. I don't use them for support and resistance levels. I use them just as we've been talking about. Now, there's a very interesting new way of using moving averages. So I'm going to right now turn off the 20 period moving average. And so what we're looking at now is the purple 10 period moving average. And I'm going to add on another EMA. At 10 periods. And we're going to make this let's make it some hideous color. Let's make it gold. We'll make it thick. Now, when you're looking at this right now, you see one line. You don't see the gold line because it's identical to the purple line. They're both exactly the same, 10 period moving averages. Now, there is a new type of moving average which traders are starting to adopt. Because as I mentioned earlier, we're always trying to find ways to reduce the lag time. And this newest moving average is easy to use because of all these things that these developers have given us. And this is called a displaced moving average. A displaced moving average takes this exact same calculation as this 10 period moving average, but it offsets it by a set of time frames. So we're not changing any calculation. We're not doing anything. What we're telling the computer to do, now I'm just picking three. Three's the one I use in my trade because I'm not going to put it out there and use 10 periods forward, or some people even use minus, which gets really weird. But all I'm telling the computer is to take that same calculation, but to plot it on the chart 3 time frames forward. So in other words, it's putting the dot on the time frame, but forward into the future. So now what you see is the yellow line, same exact calculation as the purple line, except it's moved forward by 3 periods. And if we look at it, it's a wee bit more responsive to the market, and it's also given us a little bit, moved us ahead of price. So it starts to give us some predictive qualities. So when you take this and we combine it for a moving average strategy with 2 lines, so what I have now on my charts are 2 exponential moving averages using a crossover strategy, but each one of them has been displaced in even, in my case, 3 time frames. So when we see these crossovers, they would be slightly ahead of the market. So we could have seen that price was telling us at this point to buy. we would have seen here at this point the price was telling us to close or to sell, whichever we might have been. Okay, again here, slightly in front of the market. Same calculations, except we're displacing the number, the line forward. Okay. Interesting thing, something to think about. So there's also other types of moving averages out there that you'll hear people talk about. Volume weighted moving average. Well, volume weighted moving average used to be an important moving average that was used when we had accurate volume. But volume's a strange thing. In the stock market, we get volume because you can see every share that's traded. So therefore, you can actually get actual volume on your charts. In the commodities market, you could get the actual number of contracts. So it would be a real number of contracts that were traded through the Chicago Board of Exchange or the Gold and Silver Gold Exchange, the Metals Exchange, whatever. When you're trading CFDs, and most of your trading, no matter what you're trading today, doesn't have that information. When you see volume on your charts, whether it's on the Alvexa website or the Trading View chart I use, there is no volume for CFDs, and there's no volume for Forex. There's no centralized marketplace. There's nobody who can tell you how many euros were bought and sold today, how many dollars were bought and sold today. Okay. When you're talking about cryptocurrency, there's nobody can tell you what was globally traded because there's no centralized exchange. That's the first thing. The second thing is CFD brokers, I take it back, brokers, online brokers, all use what we call liquidity providers. They're not putting your trades directly through an exchange, they're putting it through a liquidity provider who provides the pool of assets that are going through, and then that liquidity asset trader is putting it out into the markets. Well, what you see when you see volume on your charts now is a projected volume based on what is going through that liquidity. And look, a liquidity provider is a huge, huge liquidity pool. So there's thousands and thousands and thousands of trades going through. So they say that the volume of trades going through a liquidity provider is a direct reflection to the volume going through the global markets. And it does give you the right thing. Now, and today there is no really small liquidity provider, but keep that in mind when you're looking at volume at any time. But like I said, the most current thing today is the DMA, and it's one of my favorites. I've added it into my charts. Now, how would you, what are other ways that you can harness moving averages? Okay. You can use a moving average fan. You can use 3 moving averages. Okay. There's many different ways you can use moving averages in your trading. But one of the keys to moving averages is knowing what time periods to set them for. So it's worth noting that traders with different preferences may employ moving averages of varying length. For example, someone looking to invest over the long term, not trade, but over the long in securities, may perform a 200 trading day moving average. Now, the longer the moving average, it's good to give you a environmental look at the asset, but it doesn't help us anything. And a 200 period look back isn't going to help you with any decision you're making in trading. And for our type of trading, we don't go back that far. So an individual focusing on short-term trading might hone in on how a currency pair traded in and we refer to it today, but a 20-day window or a 20 period moving average. So remember, moving average adjusts to your chart. If you're looking at a 15-minute chart and you're looking at a 20 period moving average, it's 15, it's 20, 15 periods. It's 20, whatever the candlesticks are. And that is one of the days that these developers gave us the option. If you're looking at a 15-minute chart, but you want your moving average in a 1 hour configuration, you click in there 1 hour and it's going to drop on the calculation for 21 hours. It gets really confusing, doesn't it? All of it, too many choices. But one more use for moving averages is measuring the momentum of a security. We can see the momentum. We can see it in the movement of that moving average more clearly than we see it actually in price. So if a Forex trader can identify the momentum of security, he can buy or sell the asset and even take out longer short positions. To single out this momentum, an investor can look at what the financial instrument did within a short, a medium, and a longer term time frame. For us, that might be a 9 or 10 day or 9 or 10 period, a 20 period, and a 30 period. So in theory, there is an infinite number of simple moving averages, and there's a simple infinite number of periods. So if you're thinking that you will produce a weird 46 period to beat the markets, let me stop you now. It's important to use the most common calculations, as these ones many traders will use to identify daily. Well, I don't advocate you following everybody else, adjusting to saying, oh, I'm going to use a 47, a 19, and a 12. You're not going to find any difference between using a 10 and a 20 and a 30. So don't think, and when some guru tells you out there, use a 26, 27, and a 92. So the most popular moving average for our type trading, especially when you're looking for any entry and exit points, or a hyper trader, is a 5-period moving average. A 10-period moving average is most popular with us. And then a 20 period is about the last stop on the bus for short-term traders. Yes, you can adjust your charts, but a 5, a 10, and a 20 are about as far as you need to go that are going to give you viable information for our type of trading. Now, a 50 period moving average might help you gauge some midterm trends. A 200 is for long-term trend followers, and investors will look for a cross above or below in a bullish market for investing, not for trading. Now, some traders will tell you to try simple moving average trading system where you buy or sell if the price breaks the average above or the average of closing basis. Unfortunately, this is not accurate. Oftentimes, assets tick above or below the moving average only to continue in the primary direction. So in the end, it comes down to what you feel comfortable with and what your trading style is. The EMA gives you more and earlier signals, but it also gives you more false and premature signals. The SMA provides less and later signals, but also less wrong signals during volatile markets. The most interesting one is the displaced moving average. And like I said, you can adjust that displacement. I use 3. And the interesting way also is personally is using a 3-period moving average, a short, a medium, and a long. And when you look at them closer, you can start to see things that are happening in relationship between if you're using a 5, a 10, and a 30, and all of a sudden that 30 is crossing over the 5 and the 10, but then the 10 is crossing over the 5, that might tell you something, but you're going to have to establish what it tells you. There's many choices. Okay. So again, here where you're looking at a 21, a 50, and a 10. Okay. And as price fans out, now the purple line, or this violet line, is the longest period or the slowest moving average. It should be well below the price, or above the price, whether it's a long term, but above or below the other moving averages. But when all of a sudden that long term moving average crosses over the markets are trying to tell us something, because not only did it cross from the bottom, it crossed all the way over the medium term and which crossed over the short term. So there are many things that you can see or start to interpret by using moving averages. And there's many ways you can use them. And like I said, Bollinger Bands uses a moving average as a center line, then does a calculation called standard deviation above and below the price. But it's only when price breaks the moving average above or below that it tells you that a trend is entering or starting. MACD takes the difference between the two lines and starts charting it onto your charts. So moving average can offer trend direction and help filter our trades. They can offer support and resistance, and they can also help us determine where we want to put our stop losses. But moving averages do not work well in ranging markets. So remember, when markets are moving sideways or congestion, your moving average shouldn't be the tool you're using. So you can see that the moving average are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implication of an EMA versus an SMA and an SMA to DMA, the importance of the self-fulfilling prophecies, and how to pick the right time period settings, moving averages become an important tool in your trading toolbox. So thank you very much for joining us tonight. Thank you for supporting Alvexo. And if you have any questions, you can go directly on the website and use the live chat button. And I promise you, somebody will be there to answer them. So have a great night, and thanks for seeing you again. Bye now.